What's going on, everybody? Thank you so much for checking in. In this video, we're going to go over Tesla. We're going to talk about its fundamentals and where we think the stock is headed in the next 12 to 24 months. So to start us off, we've pulled up Tesla's overview on tradingview.com, and the first number we're going to pay attention to is going to be Tesla's price to earnings ratio, otherwise known as the PE ratio of a stock. Now, this number should be the first number you pay attention to anytime you are looking to analyze the fundamentals of any company. And that is because this number tells you a lot with very little. A company that is trading in a healthy range should be trading between 15 to 25 its price to earnings. This is not the case for Tesla, where you can see that it's trading at about double the healthy average of about 20. This means that Tesla is a very expensive company and it needs to be corrected, and it can do so in one of two ways. This price to earnings ratio needs to come down to about 20 for Tesla to be considered in a healthy trading range. So that means Tesla can either cut its price by half, so that means the stock will literally need to drop by 50%, or it means that Tesla can raise its annual net income in a way in which it adjusts its PE ratio. So the more that their net income grows, the lower that PE ratio will become, and the more attractive the company will be, and the more in a healthy range the company will be as well. Now, Tesla has done a great job of growing its net income year over year. You can see that it closed off the year with 15 billion in net income, and the company had just turned into a profitable company in 2020. So over the last 3 years, they have managed to move from negative 870 million per year, and it was way worse before, to about positive 15 billion in profitability every year. So this is a great sign. The company is also growing its revenue substantially year over year. You can see that its revenue grew about 18% in 2023, 51% in 2022, and 2021 was a phenomenal year where they grew by 70%. Now, sales of Tesla have been a little bit more on the fluttering side, only because of growing competition and just more economic demands. However, Tesla did just release 2 new models that are likely going to boost their sales, and they introduced new price cuts in China to promote sales and make them competitive against China's BYD and China's NIO. In terms of their balance sheet, we can see that Tesla has a significantly healthy balance sheet compared to their competitors like Ford and GM. Tesla's balance sheet has a total asset total of about 106 billion for 2023 compared to liabilities over 43. Cash flow is also healthy for the company, where you can see that Tesla has a positive free cash flow of about 4 billion. That did decline from 2022 to 2023. This could explain why Tesla stock has been losing so much value to start off the year. Not only did their free cash flow decline, but their net income before tax credits actually declined in 2023, which caused investors to be a little cautious, thinking that Tesla is moving the wrong direction. But as we already mentioned, when we're analyzing their revenue, Tesla's growth may be slowing down in terms of percentage. However, generally speaking, year over year, Tesla is still growing. And as they move on to expand other products like robotics and their batteries, Tesla is only expected to grow. This is a car company nonetheless, so overall they will move in cycles. These numbers of growth are likely to slow down over the years only because of competition and a lot of people already having their product. But as long as they stay innovative and they keep releasing new models, new technologies, then Tesla has a fighting chance of making a comeback in the next decade. Now, over the next 2 years, over the next 12 to 24 months, this is what Tesla is currently trading at. Let's talk about what we can expect over the next 2 years. Tesla is currently seeing a long-term downtrend. Ever since it peaked right around 415, Tesla has been fighting this uptrend. Every time that it has retested this level, it has gotten rejected and rejected significantly. If you're looking at Tesla here on March 8th, 2024, you can see that Tesla has an upcoming support at 150. That is a very, very critical level. If Tesla loses this support, it doesn't have much other support until 100. Now, we do expect Tesla, if the market starts to sell off, so if the market as a whole starts to come down, Tesla should be coming down with it, only because Tesla buyers already had their chance to push the stock to start off 2024. The entire market has been rallying for the last 6 months or so while Tesla has been selling off, which means that if markets decide to reverse their trend and correct now, Tesla would actually be one of the strongest decliners because bears are already so active on this stock and bulls have been questioning the stock significantly. And so if the market corrects, then we do expect to see Tesla below 150, and then when Tesla breaks below 100, we do expect buyers to come in significantly. And at that point, Tesla's price to earnings ratio would also be significantly adjusted from its current 41. So if Tesla drops from 175 or around 200 to about 100, that is about a 50% drop, which lines up exactly with what we said earlier. For Tesla to be at an attractive buying range for bulls in the long run, it needs to be corrected. So if Tesla manages to keep up its net income and decline in the stock's price, that means their price to earnings ratio will start to look more attractive, and then it will begin moving back up as the years go by. So that's as far as Tesla's analysis go. It was nice, short and sweet. We tried not to overwhelm you guys. Thank you guys so much for checking in. If this helps you, please subscribe and like. Thank you so much.